You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always, and it's that time of the quarter where I look into the inbox and try and answer as many questions as possible in about 20 minutes from you lovely listeners. A lot of great questions coming in over the last couple of weeks, and apologies for not getting to you any quicker, but hopefully this is very timely for you to hear some of these thoughts, given we are now again breaking another threshold in supply on market. Who would have thought we'd be down at 2,840 properties on the market in our lifetime? I certainly didn't think so. That comes off the back of continued weekly demand that sees over 800 properties being transacted nearly every week this year and nearly every week in the last 5 years, to be honest. And less people deciding that they want to sell their property or that they have the ability to sell their property, given they probably have less and less of an opportunity to buy somewhere else at the same time. So that lack of mobility is really kicking in, and it certainly hasn't been assisted by the Albanese government's 5% first home buyer deposit scheme, which has allowed a lifting or removal, I should say, of any income thresholds to be eligible for the scheme, and has increased the value threshold to $850,000, which is now covering just under half of the properties in the market right now. But I promise you, I bet you, I put a house on it, that it won't cover that many properties in West Australia's housing market in a year's time. What this scheme is doing is essentially sucking a lot of demand forward and sucking a lot of prices up to that $850 threshold, where very soon we won't see any houses available under $850,000. We won't see many units available for less than $800,000, and we'll start to see even one-bedroom older flats in the $500,000-$600,000 space. Who would have thought, given you could have bought those for under $200,000 6 years ago? Anyway, let's get straight into some of those valued questions that I have sitting in my inbox right now. The first one comes from Cameron. His question is, hey guys, my partner and I moved to Perth early this year. We have a goal of purchasing a property. Ideally, we want something we can renovate, add value to, and flip so we can move up the property ladder. As we're new to Perth, just wondering if you had any insights on improving gentrifying areas and areas that we should be staying away from that have a bit of risk, as well as any advice you may have on flipping houses in Perth. Thanks for the question, Cameron. Areas that I'd be looking into that are continuing to gentrify, that have some real ballast about their amenity and workforce strength going into the future, certainly sit around the city of Kwinana and the city of Rockingham with the AUKUS deal cracking on. We are talking about billions of dollars being spent over the next few years, 12 billion specifically in the next handful, and that's a few hospitals when you think about it that way, all going into that one area of Kwinana, Rockingham. Therefore, a lot of jobs will be created and a lot of need for housing, both from the Defence Department, where you might be able to create a defence housing house if you're not looking to renovate, and simply a lot of opportunities for people to move to the area for work generally. Now, if you're looking for a flip and renovate, the suburbs I'd be looking at is probably an Aurelia or a Medina. These are the cheapest properties in Perth. They are the lowest amenity at the moment, the lowest socioeconomics, but certainly got the highest potential, given the strength of the economy that's going to be down there over the next few years, for people to have to pay more for something that really gives lipstick on a pig. So that'd be my first guess. There's always opportunities in places like your Balga, your Mirrabookas, your Gurraweens. Coolbellup and Hamilton Hill and Willagee have already had massive runs. You really can't buy much in Willagee for under $800,000-$900,000 now, and most things are transacting in the seven figures as well. You may have missed that ship already, therefore, in those suburbs. And then north of the river, there's always a stock of properties in Craigie, Belden, Hamersley, Padbury on full blocks or even half blocks that are about 40 years old that you could be adding value to. You're just going to be paying some money for it. So if you can afford closer to the $1 million space, north of the river continues to attract a lot of people from the British Isles. Cameron, thanks for that question, mate. The next question comes from Paige. Paige's question is, hey Trent, I'm a first home buyer. With the new government changes as well as interest rate cuts, what's the best strategy for a home buyer to get into the market right now? Are there any grants or schemes that I should be taking advantage of? Great question, very topical question. I think I've already approached that one, Paige, in my opening monologue there. The big ticket item here, outside of interest rates dropping, fueling the continued increase in prices in the current undersupplied landscape in Perth right now, is the 5% deposit scheme. And I mentioned those thresholds before. It's essentially sucking all the prices of property in that first home buyer space up to the threshold of $850,000. If I was you, my strategy would simply be, as quick as you can, get on that policy, buy the most high value thing you can buy under $850,000 and let it run. Essentially, the strategy really is just get in the market right now. There's a consensus amongst experts, amongst punters around the barbecue, that this is going to be mayhem for people who aren't in the market right now. Don't be shy about your offer. Don't be stupid, but also don't cry over spilt milk when it comes to $10,000, $20,000. In fact, I've been saying that for 6 years now, to be honest, when these properties that are at $800,000 were at $400,000. Nonetheless, everyone gets on the market at the time that they have the ability to, and therefore my advice would be just get on. And to get on, that means get yourself pre-approved with a great bank from a great broker. Make sure that you're prepared when it comes to deposit, but also your stamp duty. The deposit's 5%. The stamp duty you should allow for is about 4.5%. So really, even though the deposit scheme is for 5%, you still need to allow for 10% in terms of the money you've got to buy that property you're after. A lot better than having to allow for 20% plus stamp duty. But yeah, if you're buying a property in the $800,000 range, you really should be allowing about $33,000 plus costs in that space. And then you've got to allow your 5% deposit with the government scheme too. So not easy for people these days. And to compare this to 5 years ago, that same property would have been worth about $400,000 in Craigie. If you were able to run with a 5% deposit scheme back then, that would have been $20,000 plus no stamp duty. A bit of a kick in the nuts for young people who are 5 years younger than the people who were young people back in 2020, who now have to come up with $80,000 instead of $20,000 for that same outcome, the same house in the same suburb. But we deal with it and we find solutions along the way. Outside of that, there are house and land package schemes, essentially, that help you have lower deposits even further than that. They can be a bit risky if you don't have the cash you need, but you can talk to people in that house and land space. People are even lending for their deposit these days, which I remember seeing about 15 years ago. They've brought that back in. You can actually lend not only for the bank loan, but also for the deposit, or most of it as well, which is crazy to think, really. Next question comes from Haley. Haley's question is, Perth has seen fantastic rental yields. For a new investor looking for yields, is it still a good time to get into the market? And should we be targeting houses or units? Haley, I'll be sending you back to the recent podcast we had with Lachlan Delahunty 3 or 4 weeks ago. The advice there is that units haven't grown as much as houses in the last few years, and therefore maybe a bit of fat left in them more so than houses. We also know that units generally have a higher rental yield than houses do, simply because people are paying rent for a roof over their head. And whether it's a unit or a house, they're paying a similar rent. And we know houses are more expensive than units, therefore the yield is higher for units. So that's what I'd be looking for. Recognise that vacancy rates are still extremely tight, and we're still seeing only about 2,000 properties on the market to rent, which means that there's minimal downside risk right now in being a landlord. But I would also still make sure that I'm very specific, therefore, about who I'm renting it to, so that any money you do make in the cash flow side of renting properties out as a landlord is not eliminated by having to pay maintenance costs for tenants that have wrecked your house. And in addition to that, making sure that you're doing a thorough building inspection when you're buying this property, which is hard given the fervour at the moment buying property. But you're doing a thorough building inspection so that you hopefully won't come across yearly maintenance costs in and of itself that are into the thousands and thousands of dollars. That really does erode your strategy of rental yield if that's what you're going for. The final point I'll make on that is, if I was in your shoes, I wouldn't be going after rental yield. Normally, if that's the strategy, you'd be hitting $5,000, $10,000 if you're lucky in positive gearing. That pales in comparison to the capital gains you'd be trying to get buying a good property at a good value that has capital gains. And in this market, you'd like to think that you'd be making $60,000, $70,000, $80,000 at least a year right now on a median house price house in capital gains. I know which one I'd be going after if I was you, Haley. Haley, thanks so much for your question. Next question comes from Kelly. Kelly asks, I am a buyer and I'm feeling a bit frustrated with the lack of available properties. I remember you said, Trent, that we have a record low of properties right now. What's the best strategy to secure a home in this low stock environment without overpaying? Isn't it interesting, the questioning that we're getting at the moment through the inbox? Very much of the similar vein, isn't it? That we have young people trying to get into the market, struggling not only from a financial perspective, but also just from a practical perspective, getting in front of a selling agent and being taken seriously. The first advice I would give you is, again, be pre-approved. Secondly, consider a buyer's agent. Buyer's agents will cost you about 2% of the purchase price. Prices in Perth went up 1.6% last month. So if you think, look, I'll pay my 2%, but that's really the equivalent of me missing out for another month and a half. At the way I'm going, it might be 6 to 12 months before I can even get a property by myself. So really consider that value proposition of getting a buyer's agent. They are essentially your access, your spare key into the property market right now. And the reason for that is not only do they have stock off market generally, selling agents will take your offer far more seriously, especially unfortunately if you're a first home buyer, if you're being represented by a buyer's agent, because it means the buyer's agent has already vetted you, because they won't want to be wasting their time trying to buy a property right now if you can't end up settling it. That would be a bit of advice on what's the best strategy right now, because the last advice I want to give you is just overpay. And that's what you're worried about, is overpaying in this market. Generally, the market, even if you do overpay, is probably making up for it over the next few months, but you don't want to be that sucker who overpaid and the music stops at some point in time. And no one knows when the music will stop. We are confident it's not the next year or two, but we also know with news in the newspaper recently about BHP's tiff with Chinese steel manufacturers that could be sometime a lot quicker than we think due to external factors that aren't relating to undersupply of property in this market right now. Always do due diligence. Never overpay more than, I'd say, 2 or 3% more than what you think it's probably worth, and get yourself a buyer's agent and a broker that will compete for you on your behalf. Thanks a lot for that question, Kelly. Next question comes from David. David asks, what are some common mistakes sellers are making right now? Should I still expect my house to sell at the first home open for a huge price? The first mistake, in my opinion, that a seller would make is selling their home in the first home open. Now, if you were to do that last weekend when the grand final was on, I can tell you there would have been a fraction of the people the home opens last Saturday than there will be this Saturday, simply because most of us are watching the footy. Never let your sales agent convince you to sell your property in the first open, especially in a market that is growing 1.5% per month. If you're going to sell, you're obviously putting your stake in the sand, which is fine. You're accepting the prices at this stage in the market. That's fine. That's your risk profile. But definitely at least flush out 3 home opens, a Saturday, a midweek, and another Saturday. At that point in time, you'd at least have an idea from what should be 40, 50, 100 people coming through your house right now of how far the market is looking to push, and hopefully you flush someone out who's a bit desperate, a bit silly, and will go an extra 2, 3, 4, 5% on top of the second highest bid because they are just so desperate to get into a house, they'll pay what they have to within their affordability. That's the golden goose you're looking after, and it's hard to flush that out in one home open. That's the biggest mistake at the moment. And then the other one I would suggest is if you are a homeowner looking to move into somewhere else, if this sale is not based on the owner being deceased, then you'll need somewhere to move to. If you haven't found somewhere to move to, then you don't want to be putting yourself into a position where you're homeless at the end of settling your property. So either have a property that you've already got under contract with a long settlement date to allow you to sell your property, or when you're selling your property, make sure that there's either a rent back for free or a long settlement term so that you will have time to go and buy your property, which I promise you will be far harder than selling your property in this market. Don't be homeless. That's probably the best advice I can give you right now. Next question I get is from Tony. Tony asks, I have a big block and I'm thinking about subdividing it. How do I know if it's a good idea and is it still profitable with today's high construction costs? Tony, great question. How do you know if it's profitable? Well, you can do a back of the envelope, really. How much will your property sell for at the moment? There are a number of online resources that will give you a rough guide or at least get an appraisal from a couple of agents. And then think, okay, I'm going to subdivide my property. Let's say you're subdividing just the backyard off. Therefore, back of the envelope, if the backyard is worth $500,000 and your house you could sell for at the front without the backyard could sell for $700,000, there's $1.2 million in revenue. Remove $100,000 as a rough number for the cost to subdividing, 1.1 mil. If that is more than what you could have sold the whole thing for, then yes, it is more profitable to subdivide your property before selling than to sell it by itself. And is it still profitable with today's high construction costs? The great thing about just subdivision is you're not doing a lot of construction. You might be doing some demolition, some land clearing. You may be installing sewer connections and power connections. Those costs have gone up slightly, but I'd be confident in most residential properties under a quarter acre in Perth that are not in the hills, you'd be able to get that whole exercise done under $100,000. If you can allow that and you've got some change at the end, you'll be fine. To do it, I'd be getting a subdivision consultant in. There are a few of them around in Perth. They should be able to help you project manage that along the way and give you a good quote up front before you get the process underway as to what it may cost to get it done as well. The next question comes from Kathy. Kathy asks, Trent, rents seem to be going up forever. What's driving this? Is there any relief in sight for tenants? Rents have actually started to plateau in the last few months, Kathy, not because of an increasing in supply of properties on the market. That certainly hasn't been the case in the rental market, let alone the sales market. But it's a case of simply just affordability. Interest rates don't affect tenants. Wages affect tenants. So as wages haven't been increasing 10% a year, eventually we got to a point where people just can't afford to go more. The median rent in Perth is now at $690 per week, which is 85% more than it was pre-COVID. And therefore, you can understand for those people in a rental position, their wages haven't gone up 85%. So we're hitting a cap, and I'd say for most people that cap's about $750 a week, which doesn't leave a lot of space above that, especially for the higher value properties in the nicer suburbs, for great rental yields, which is why most investors focus on capital gains. They won't continue at the same pace as the capital growth of the same properties, simply because of the reason I just said. I would expect rents to continue to tick up marginally from here, and Perth rental yield to start to drop on average over time as our house values continue to grow but rents start to cap out. Good question from Sam. Sammy's question is, interest rates have started to drop. How will this impact the Perth property market and what does it mean for mortgages? What it means is we've had 3 interest rate drops since the peak in interest rates last year. That has allowed people to spend about $50,000 more with the same salary than they could have last year on the same property, simply because they can afford a larger loan. So that's what it does to the property market. What does it mean for my mortgage? What it means is that your $600,000 mortgage should be about $450 a month cheaper, which is great for the hip pocket if you are a landlord or an owner-occupier right now. It means that it can help go into paying your mortgage down more or allow you to just cover the extra bills we've had with inflation over the last couple of years. But generally, it means prices go up. As interest rates drop, it allows a tight property market to grow in value even more. Unfortunately, that is the outcome for those struggling to get into the market. And fortunately, for those who are pegging their nest egg on the property they own. Last question comes from Julie. Julie asks, what's the key to finding a suburb that's likely to have strong growth in the next few years? Are there any hidden gems in Perth right now? I'd be following infrastructure. I'd be following capital spend. And we know that, again, AUKUS is going to be huge for Perth. Metronet has happened now. That has increased the amenity of properties all the way up to Ellenbrook. It has increased the amenity of properties along Roe Highway. And it has increased the amenity of property up to Yanchep because it's now given them a train line. Not many people are using it right now, but it will over time mean extra community value to those in the area. AUKUS, I think, is massive, as I've said. I think Rockingham Kwinana is just going to keep going on an inordinate run based on that massive pressure needed to house the people that are going to be working on AUKUS for years to come. Outside of that, it's really just a flight to amenity. The better suburbs are going to continue to grow based on the fact that interest rates are dropping and people are moving from their house in Canning Vale to Rossmoyne, from Bayswater to Mount Lawley, from Padbury to Waterman's Bay. As you can afford more, the headlights start to rise and you start to move within your ambition as well. That's what's going on right now. A lot of people jostling for position in Perth as interest rates decrease, and that's been fueled by the FOMO of prices continually rising. Guys, thanks a lot for those questions. I hope everyone got some value out of that. We'll speak to you next week.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!